Hi, I'm Rishit Shah from Tally School, and in this video I'm going to explain you about three basic accounting statements in accounting. Any guesses which are they? So they are balance sheet, profit and loss statement or profit and loss account, and cash flow statement. I'm going to explain you the most basic explanation of all the three statements and what these statements mean for a business in accounting. So let's start with one of the most basic and one of the most important statement of any business, which is balance sheet. So as the name suggests, it is the balance between the assets and the liabilities. In any business, you have assets and you have liabilities. Let us look at the balance sheet which I have prepared for your basic understanding, and let us go through the terms which I have written on the asset side and on the liability side and what those terms mean. Let's start with the asset side. Now here we have buildings. So buildings are our assets. We have purchased a building, or we might have taken lease on the building. We are using building for building our business, or we are doing the business in the buildings, and therefore they are our assets because we are using them to generate profit. Second one is computers. Now in every business today we have computers to use them. I'm currently making this video on my computer. You might be watching this video on your computer. Every business has computers to work on, and they generate in some or the other way profit for the business by using computers. So they are computers on the asset side. Now cash balance and bank balance, both are basically the same. The cash balance suggests that you have cash with you currently, and bank balance suggests that you have your cash in the bank currently. So whatever is at your disposal that you can use to generate profit for your business are called assets, and they're always listed on the right hand side or the asset side, which is this side of the balance sheet. Now the name is balance sheet because you have to balance your assets with that of liabilities. So if you balance your assets with your liabilities, then your balance sheet is correctly formed, and this always balances. In any case it is not balanced, there must be some misunderstanding or there must be some mistake in the preparation of the balance sheet. So let's go to the liability side. The first term is share capital. Now share capital means the capital that you put in the business, and it is a liability because the capital that you put in the business is a liability for the business, because you and business are both different entities. Think as if you and business are two different persons. You are giving your business the money, so for the business you have given him the money, and therefore it is the liability for the business because it has in some or the other way provide you back your money in the form of profits. Therefore it is always listed on the liability side. Share capital is always listed on the liabilities side. Now the second one is loans. Maybe for running the business you would have taken loans from some banks or from some institutions for meeting your financial needs or for meeting your money needs when you need them, or for some long-term objectives, like people take loans for, let's say, buildings. Here we have buildings, so you might have taken a loan for constructing a building. So at both the same time, the building is your asset but the loan is your liability or your business's liability. Loans are the money that you take from other banks or other people, and you have to pay back the money in the form of interest and principal. Principal is the loan amount that you have taken, and interest is the amount that you pay as a charge for using the funds that you have taken in the form of loans from other people. Now we will move on to the third term, which is creditors. Creditors in any business mean that you have purchased something from your supplier and you have not yet made the payment. They are called creditors. And on the same hand, if you have sold something and you have not got the payment for that, they are called your debtors, which will be listed on asset side. Think of it as like this: whatever you have to take from someone legally and legitimately in your business are called assets, and whatever you have to give to someone, including you, from your business legally and legitimately in your business, are called liabilities. So assets are your strength and liabilities are somewhat basically your weaknesses. If you want to create a successful business, make sure you try to increase this asset side as much as more than this liability side. Keep this side less compared to this side. So for example, you can increase your assets, and on the same hand you can increase your liabilities compared to the assets. So for example, your total assets are 10,000 rupees and your liabilities are 7,000 rupees. That means your business is worth 3,000 rupees currently, after deducting the liabilities from the assets, if you today sell your business. This is how valuations are done by people of different businesses and different companies. So this was the balance sheet, and remember that the total of both the liabilities and the asset side is always equal. It is not more, it is not less, it is always equal. The liabilities and the asset side should be equal, otherwise you have created a mistake in the preparation of the balance sheet. Now going to the next statement, which is also one of the very important statement or account in accounting, is the profit and loss account or profit and loss statement. Basically this statement shows whether you have a profit or whether you have a loss in your business. Let me show you how it looks like in simple form. So the right hand side are all the incomes and the left hand side are all the expenses. Basically what we do is total the right hand side and total the left hand side. Now we deduct the total of the left hand side, that is expenses, from the total of the right hand side, and we get the profit. If we get that figure in the negative, that means it is a loss, as the left hand side expenses are more than the incomes. Let me show you by giving some numbers. So these are incomes. Before we go into numbers, let me explain you what all these means. So on the income side we have sales. So sales means sales. If you sell anything in your business, it will come here. So let's say you have a business of dresses and sarees. So you say, let's say you sold 5 sarees and some other dresses, and the total sales figure will come here. Now direct incomes. Now other incomes that are related, that are highly related to your business, will come here. So let's say you earned some commission on selling sarees apart from the sales which we have done here. So that will be a direct income for your business because it is directly related to your business. Then we put a total here of these both incomes, and the another one is indirect incomes. Now these are the incomes which are not directly related to your business but happen in the businesses. For example, we have here our sarees business, and indirect incomes we have, let's say, interest income, because we have given some money to some people from the business, so they have given us the interest on that money. In the previous slide we have already discussed loans, so let's put it here. You have given the loan here, and therefore it is your asset, and for that asset you are earning interest, which is an indirect income, and which will you show in the profit and loss statement. So that is the indirect income, and we put the total here. Now expenses, as usual, whatever you expend or whatever you expend or whatever you try to purchase and earn profit from by selling it are listed here. So the first and most biggest expense in any business is purchases, which is listed here. Then the direct expenses related to your business. So let's say you purchased 10 sarees here, and the expenses relating to the purchase can be delivery expenses or handling expenses of the saree stock, or any other direct expenses which is directly related to your business. So they both will get listed here. So let's go and let's quickly know what this all means, what this upper part of the profit and loss statement means. It can also be called a trading account, because you basically trade here and nothing else happens. You trade, that is, you purchase sari and you sell sari, and the expenses of that here appear here, and the direct income, which is directly related to your sell, appear here. So this is basically a trading activity that you are doing, and therefore it is also called trading account. But nowadays we prepare the whole profit and loss statement in one statement, because it is good to know the entire picture in one statement other than two different accounts. Obviously you can prepare two different accounts if your accounts are rather big, but nowadays generally one statement is prepared. So I have also shown you the one statement. Therefore, if you total this to both sales and direct incomes, and total this to purchases and direct expenses, you will get the gross profit or the gross loss here. So let's say, for example, your sales are 10,000 rupees, direct incomes are 5,000 rupees, your purchase are, let's say, 7,000 rupees, and direct expenses are 3,000 rupees. So here the total comes to 10,000 rupees, and here the total comes to 10,000 plus 5,000 means 15,000 rupees. So your direct incomes plus sales equal to 15,000 rupees. Your purchases plus direct expenses equals to 10,000 rupees. So now if you deduct 10,000 from 15,000, you get a gross profit of 5,000 rupees. On the other hand, if your purchases and direct expenses become 15,000 rupees and your sales and direct incomes become 10,000 rupees, then your gross loss will be 5,000 rupees, which you want to avoid at any cost in any business, because you are doing business to make profit or to generate profit. So let's go back to the profit scenario, and we have a gross profit of 5,000 rupees. Now that will be carried forward here, and we will then total the indirect incomes plus gross profit and deduct the indirect expenses, and we will get the net profit. On the other hand, if these indirect expenses are more than the indirect incomes, or there is a gross loss here, we will get here net loss. So let's move to our example. We have 5,000 rupees gross profit. Now let's say we have indirect incomes of 1,000 rupees and indirect expenses of 500 rupees. So we have net 500 rupees profit from this to indirect incomes and indirect expenses and indirect incomes. and we have 5,000 rupees gross profit here. So total net profit we have is 5,500 rupees. This is how profit and loss statement works. It is very easy and very simple to understand. You just have to remember that expenses are listed on the left hand side or the expenses column, and incomes are listed on the income side or the right hand side. We have to deduct purchases and expenses, whether direct, indirect, from the sales and direct or indirect incomes. Basically, what we get from a business, we add it on one side, and what we pay to run the business, we add it on the one side, and then we deduct from what we get to what we expended, and we arrive at a figure which can be a profit, which can be a loss. And that's why it is called profit and loss statement. It is very simple to understand. You just have to remember the format a little bit. That more direct and the more important figures come on the top. The more indirect and less important figures come at the bottom. This is how statements are prepared in accounting. It is very logical and very easy to understand. Once you go through some real profit and loss statements, you will understand what I want to say very much clearly. So this was profit and loss statement, my friends, and the next statement is very much important statement, but not many people understand it because it is a kind of tricky statement, but I'll try my best to make you understand in the most simple and basic way possible. So let's go to the cash flow statement. So what is a cash flow statement? A cash flow statement is basically a statement which shows how your cash, and that includes your bank balance also, how your balance of cash, whether in bank or whether in actual you have the cash, flows in your business throughout the year. So let me show you the statement and you'll understand it more easily. So cash flow, it is basically a path from your balance sheet of the previous year to the balance sheet of the current year. So let me explain you it in more simple manner. So we have here first cash flow from operating activities. Now that means how much cash has flown into the business or flown out of the business from operating activities. So we have sales and we have other incomes. That means we have gained cash flow from operating activities. Now we can also put expenses, purchases, that will also come under cash flow from operating activities, but I have put few examples to make you understand, otherwise the statement would be much longer to understand and that would make this video very much long. So whatever you gain in cash from operating activities, you put it here, and whatever you expend or whatever the cash goes out of the business through operating activities, that is the basic operating of the business, comes here in cash flow from operating activities. Then we put a total here. Now the second cash flow is cash flow from investment activities. Now in any business there are certain investments done. So if you purchased some shares of ABC Limited, that means your cash went out of the business and shares came in because you purchased the shares and gave the cash in exchange for the purchase of shares. On the other hand, if you sell the shares of ABC Limited after some time at a profit, that will come here too, but that will be a positive figure here and not a negative. Now this was investment activities cash flow. So whatever you invest in your business and whatever you get from that investments will all come here under this heading. Now the third one is cash flow from financing activities. Now financing activities means taking a loan or getting money to run the business in other forms such as capital getting capital, or anything that is in financial subject. So let's say you have taken a loan, and it will come here as you have got some new cash in the form of loan. So this was cash flow from financing activities. As I said, if you take money in your business in the form of finance, like getting share capital by issuing shares, getting loan in the form of, let's say, 10-year loan or 5-year loan or 1-year loan or cash credit, anything that will come under the financing activities to run the business. And on the other hand, if you pay the interest on the loan, that will be deducted from this financing activities, because that is needed to run the business. You put the total of all the three activities and you get the total cash flow. You add your opening cash balance at the beginning of the year, and you get your closing cash balance. Now this is how it works. In business, we make profit and loss statement, so we get how much profit we have earned and how much loss we have earned if we have had the loss. In the balance sheet, we know how much assets we have and how much liabilities we have. But with the help of the cash flow statement, you will know how that losses occurred and how that profits occurred, or how the assets have been there and how the liabilities have been generated, which are in the balance sheet throughout the year, because you will know where the cash is coming from and where the cash is exactly going into if you look at the cash flow statement. It is the whole summary of the year of your cash flow. Therefore, it is called cash flow statement. By looking at the cash flow statement, you can also know how cash is being applied, or how the funds are being applied by the business or by the person who is handling the business, and how much they are getting back. You can also create some ratios on the basis of this and take important decisions. Cash flow statement is very much important statement, but not many people know how to read it. But today I have shown you how you can read it. So let's say, for example, you have a balance sheet of year 1 and you have a balance sheet of year 2. And in balance sheet of year 1, you have assets of 10,000, and in balance sheet of year 2, you have assets of 15,000. Now, if you want to know how that asset of 10,000 became 15,000 from year 1 to year 2, the in between path, or the middle path from year 1's balance sheet to year 2's balance sheet, is cash flow statement. You look at the cash flow statement, you go to the investment activities, you go to the financing activities, you go to the operating activities, and you will know where the cash has been expended, or where the cash has came from, that our assets has increased in the balance sheet. It is the path that connects the year-on-year balance sheets, and it gives how the business is being operated in terms of operating activities, in terms of investment activities, and in terms of financing activities. That is cash flow statement. In short, it is a path from year 1 to year 2, and whatever is done in between them. That's why the statement is very much important. By looking at the balance sheet, you know that you reach this stage from year 1 to year 2 to year 3. But if you look at cash flow statement, you will know how we reached that stage. So as I said, in the year 1 you have assets of 10,000, in year 2 you have assets of 15,000. So you know that your assets have increased significantly. But if you want to know how your assets have increased that significantly, you can look at the cash flow statement and you have your answer. That's why this statement is very much important. So this was cash flow statement, and this is how it looks, and this is how you can prepare it too if you know a little bit of accounting. So this was the fourth and the last video of the basic accounting course. which is free for anyone, whether you are from science field or whether you are from commerce field, whether you are from any other field, arts field, and any other field that I don't know. You can go through this video, you can go through the first 3 videos if you want to understand the accounting from the very basic, and I've tried my best to make you understand it. If you have any problems or suggestions, or if you don't understand anything, you can always comment below and I will be happy to help you by commenting. I am sure that you have understood accounting, basic accounting very well, and if you have understood basic accounting very well, you can go and start the free tally course online, which I have put on tallyschool.com, for which I will provide the link below in this description of this video. So go ahead and start the free tally course online to learn tally, basics of tally on Tally School. Thank you for watching, and once again, if you have any problems, comment down below. I'll be happy to help. Thank you for watching this video, and take care and goodbye.